So it's Mark and Richard from Cubed, and we're here for a podcast, and we've got Tim from Lambert Wealth in, who's going to talk about his journey so far and working with us here at Cubed. Hi Tim.
Morning.
How are you?
Very good, very good.
Good. Do you want to tell us much about how your firm came about?
Yeah, so I have been advising for 13 years, and then after 13 years, yeah, even though, yeah, I might be a bit younger than most other advisors, which
Right.
I guess is why we get on. And then after 5 years, I was, not disillusioned, but wanted to set something up where I had control, could work with the people I wanted to work with. It wasn't all about targets and things like that, because traditionally when you're starting up, you're running around like mad. And 8 years ago, set up Lambert Wealth.
But for our viewers,
Yeah.
wealth management,
Yeah.
what does that mean?
It can mean a whole host of things. So you've got financial advice, financial planning, wealth management. They tend to blend. I think wealth management is often seen as high net worth individuals. You've got to have millions and millions in order to, do the job. But in reality, it's more about, I see it, building wealth. You don't necessarily have to have those millions. You don't really, need to have so much disposable income or a massive business. It's more about wanting to work towards something, wanting to work towards building your wealth.
Yeah.
So financial advice and financial planning are similar as well. Ultimately, I see wealth management as something that you or clients want to work towards and build their wealth.
Well, we're forever reading various people aren't licensed to give financial advice.
Yeah.
Lambert Wealth, I'd imagine, is different. You've had to go through a number of exams, hurdles, hoops,
It's constant, yeah.
work experience.
Yeah, as you'd expect. I mean, my dad was an advisor as well, and so I started off working for him. And
Did he have his own firm? Or?
he had his own firm.
Oh, right, nice.
And then got to learn the ropes, following him around. Then went to go work for another firm as well. But all the while, you're kind of shadowing whilst you're learning. A little bit like with accountants learning. I assume what you guys are doing.
Yeah, it's the same.
Yeah, and then in order to actually advise, you've got to do so many exams, and then you get to a certain level. Now it's diploma level, and then you can go beyond that and work towards chartered level, and then ultimately you've got to then maintain those standards and constantly do the exams. Tax rules are changing, investments amounts are changing that you can put into pensions and various other things. So it's not just great, you've got your qualifications and you can sit back and relax.
I suppose like accountancy, the tax legislation changes all the time. It changed last week, as we know all too well. But when you look back over maybe your and your father's wealth management experience, have there been in sort of any 2 or 3 landmark events? I'm thinking maybe the advent of workplace pensions, the opting out. When I think back into my dim and distant past, I remember being given the option to opt out of something.
Yeah.
I don't know what I was opting out of,
Yeah.
but everyone was doing it, so I ticked a form.
Yeah.
What are the 2 or 3 big changes that you can remember?
So for clients or individuals, that opting out was massive. So people would opt out of their state second pension, and then that might mean that they're not necessarily getting as much into their pension. Basically, the other thing would be
Secondary pension.
State second pension.
That
SERPs. Yeah.
Bit of jargon.
Yeah, exactly, and that was to a certain extent detrimental. But I think the other one was opting out of your work pension. So if people would opt out of the work pension and say, right, I've got that money in my pocket instead of it going into the pension that I never see before, and then that's created potentially a bigger shortfall for so many people that could have saved but didn't. And so the auto enrollment that you mentioned, that was a massive change in the way that everybody's had to think about it and operating, because you have to contribute to the pension in order for the company, realistically usually for the company to contribute as well. And it's changed a mindset in people. I notice a big difference between typically 50 and 60-year-olds who kind of thought it was all taken care of, to the 30, 40-year-olds, business owners, 20-year-olds that kind of know, I need to put something in, either be it for them personally saving or in order to get a company contribution.
Since Cube's been started, we've been aware of workplace pensions, but does it go back a lot further than that? You know, the obligation to make one available for your staff? Or
It's been a while now.
7 or 8 years, I think, off the top of my head, I think. I mean, I have to fact check that, but it's been going, for a good while now.
As long as Cube's been going, right?
Yeah. It was, back in the day, you'd have defined benefit and final salary, and it's that shift from the final salary being, no matter how long you worked there, or if you worked there, once you left, you would get a guaranteed income. You didn't have to contribute into it, so it was kind of all taken.
My father was like that. He worked at BP all his life. He got the number of years service divided by 40 or 60, I think it was, times his final salary, index linked. So throughout his what would have been 22 years of retirement, he was getting a decent final salary pension, index linked, but that's not always the case now.
It completely changed because it's expensive. You get these BT you hear about, there's a massive deficit. How did they continue to fund that? So at some point they had to stop. Those people that are in those now are benefiting from it. But that again was then when there was a shift from final salary to defined contribution and companies having to contribute into the pension. Not necessarily having to, but realistically up to a point contributing into the pension. Then the legislation changed, and then they had to contribute into the pension for all employees. So all your business owner clients, realistically, if they've got employees, they will have to have auto enrolment or a pension scheme in place. And then it's about, okay, well, what's the right one? Is it ticking a box and going into Nest, or is it thinking about it a little bit more and then once it's in, making it work as hard as possible? And I think that's where I come into play a lot more.
Well,
most of our clients, they're all aware.
They're all aware of it, and we probably routinely, assist them or avail them of, people's pension, smart pension, Nest. You've touched on the state-funded one, in case you knew what that meant. But are there others? I mean, they're the ones we come across.
They're the ones
frequently.
on there.
They're the ones that are cheaper, easier to set up. People's pension, Nest is kind of box ticking exercise. Great, you're funding into a pension, but when then you look at perhaps the underlying investments, they're somewhat limited. You've got the other providers. You've got the Avivas, the Scottish Widows, the Aegons. The bigger ones that then you can create a group scheme which complies with auto enrolment, which then allows you to, have, should we say, access to more investments. And
is there a limit, or is there a point beyond which you're allowed to, or can you do it from day one? If you wanted to set up a Cube pension scheme with Aviva, is there anything to stop us?
Sometimes there's a limit. They have to have a certain number of employees, but if you're going to be growing the business, usually, you can, with Aviva, say, look, we'll start now with 1 or 2 people, but in reality this is going to go to 5, 10, and then whatever. So as long as you can justify it, it's all right. Typically you would get advice for it as well, so we would set it up initially with a view then to bolt on extra employees.
So basically workplace pensions is where most people probably start in terms of thinking about wealth management.
I think so.
Where would you suggest they might look next?
So within the business or as an individual?
As an individual, I'm thinking, most of our owner managed businesses, their personal capital is invested in that company.
Yeah.
The success of that company. They may have a house, but they're normally reinvested in the business itself. What might be available for them to think about?
So away from actually you having the financial cash, so investing, you've also got to think about protection, and that is, you're setting up a business, if we're looking at it that way. What happens if you or one of your key employees that you are fully reliable on is ill or injured and can't work? Ultimately the profitability of that business could hit the floor and you could go bust, for argument's sake, or it makes things very, very difficult.
This is the key man insurance.
Key man,
Life assurance.
Life
You've
assurance.
helped us with that, by as we're 2 partners.
Yeah.
if one of us were to disappear,
Yeah.
you provide provision for that.
There's a very good big gap to fill with you guys. Obviously, if one of you would, you know,
Goes without saying.
so and it's it's plugging that gap so that the business can continue to operate.
But that kind of advice is key for business owners. You know, you think about the growth that we've gone on. You know, you never think of that at the beginning.
But it's like, how much work have you put in?
Yeah, of course.
And time dedicated to setting up the business.
Yeah.
And then, you know, one unfortunate incident could mean that you're, you know, then all that hard work goes to waste.
So key man insurance, like I always think, you know, Mark in his example as, you know, the wizard of tax.
Yeah.
If he disappears,
Yeah.
you know, how does key man insurance operate? Can I go out and buy someone?
Effectively, yeah. So key man specifically like that. You can do it with an illness or injury, or, you know, should Mark pass away, a lump sum would then be provided to Cubed, and that can plug profits. Obviously, then it's taxable if you don't spend that money, but also use that to recruit a replacement for Mark, or a contractor if, let's say, he was ill, someone to come in for a period of time.
So it works for illness too.
You can do it illness, so you can do it for serious illness.
What stage of a company's journey would you kind of recommend something like that?
To be honest, right at the beginning,
Really?
it's worth considering and having eyes on and looking at it, because if you're, you know, be it a key individual or a partnership and something happens, you know, you can always increase it. So it's not like, right, I'm going to miss out on 200 or 500,000 pounds worth of revenue here. You know, you can always have eyes on, and it's a gradual process.
All of our clients, you would say one or two individuals in each of those businesses.
It's not overly
Is
expensive, that insurance, either.
No,
You know, that's
it's
the
not.
thing. When you first start, you start thinking of costs, and you've got to keep it as low as possible. But, you know, something like that is
20, 30 quid a month, you know,
Yeah.
from you know,
More
the
than
lower
manageable.
end.
Yeah.
Like, we're joking and talking about food and everything like that. You'll spend more on dog food or on coffees than, you know, you would on perhaps yourself. And it's a similar principle with insurance as well. Has a bad rep, but that's why you.
So what would you get for, say, £100 a month?
It depends on the age, but if
criteria, yeah.
you know, and that's typically what it would be based on. But if it was a business starting up, you
And
know,
most need medicals?
again,
Is there a medical requirement?
there's a various limits. So if you're younger, you don't need a medical. If you're perhaps, you know, got to tread carefully, then they will potentially write to the GP, and you might have a medical just to, you know, make sure that everything's right. But that's why getting it right in the first instance is important, and that's why people with insurance say, "Oh no, it's rubbish, it doesn't pay out." But that's because they might just be looking at bish bash bosh, get it set up, don't set it up properly, and then it's not going to pay out. You know, if you do the underwriting, which is what we're doing initially, and it's sorted initially properly.
Underwriting meaning just basic fact finding.
Exactly, answer the questions, and, you know, and it's as simple as that. And perhaps having a medical, and then once it's in place, it is in place, but you've got that security.
When you're speaking to new clients, is that what you do? You kind of go through their business, through their individual needs, and that's when you can advise?
Aims and goals.
Similar to us, I
Yeah,
guess, yeah.
very, very similar. And
Yeah.
I think that's why there's a lot of cohesion in terms of, you know, us working with various clients, because it is about, you know, why are you working? You know, what are you looking to achieve?
Yeah.
You know, but what would happen if?
But your wealth management offering,
Yeah.
it's for everybody. You know, it means there's somebody who's 60 with 3 million quid in the bank, or
Yeah.
someone who's 26 and
Yeah.
just started a online influencer company. It would apply to
Yeah, exactly. And that's partly why I set up the business, because previously, you know, I was having to work with individuals that, you know, maybe I didn't necessarily build that relationship with. And I set up Lambert Wealth to help those that wanted to be helped. You know, you've got to be wanting to look to build your wealth, or frankly already have your wealth, but, you know, but happy to be proactive and go from there. And, you know, I'm building the team. We've got, you know, certainly Julie, who is amazing, who you've you know, worked with.
we can double vouch for her.
Yeah, she's been
Phenomenal.
great. Yeah,
phenomenal.
and so it allows me to help, should we say, a broader, you know, range of clients and the startup influencer who doesn't know, where to turn first. And
do you get much resistance? I mean,
is it a tough pitch?
Or do people come to you?
I think
we very much came to you because we knew you.
Yeah.
And then it became quite apparent that maybe every one of our clients should be thinking.
Yeah, it's reputation and relationship based in terms of what I do. It's all around on trust. I've only ever worked off the back of referrals, and so therefore, fortunately, it's been a lot easier in terms of building up that client base and working with individuals because they've wanted to have a bit of help. It might have been one thing initially, and they wanted me to help with their pensions, or they want a mortgage because we have that as well. And someone said, "Oh, you should speak to Tim," and then it's a warm introduction, and the barrier isn't so much there. When I first started out, it was very different. And
of course,
you're a youngster and 20, I was 20, 21, and people were sitting in front of me and being like, "Well, what do you know about wealth management or financial advice?" And I think, fortunately, after 13 years, or nearly 15 years, come to think of it, it's a bit different now. So the barriers that were there aren't there so much. Sometimes the barrier is people wanting their cake and eating it, wanting to save tax, but also, wanting the
biggest possible mortgage.
And I was just saying, some clients want the cake to eat it, but you just have to be realistic. You just have to manage expectations.
Have you seen a difference in the younger generation's attitude to planning and stuff?
Massively.
Really?
Yeah.
In a positive way.
Positively. The startups, the people setting up their business, they kind of know that they should be saving for the future, whereas, perhaps it's almost in three tiers. You've got the guys that are sorted, the baby boomers perhaps, and by sorted I mean they've been very lucky. Final salaries, the property market and everything like that, and properties rising in prices, and they've really lucked out.
What's that? The baby boomers is people born after the war.
Yeah, pretty much.
Grew up in the 60s.
Yeah. I'd say the 60s onwards perhaps, and then you've got.
So my mum and dad really.
Very much, our parents have as a generation been very lucky for a whole host of reasons.
Yeah. I suppose most people would see their main asset as probably their house or their home.
Yeah.
But with our parents, it would have been their pension was probably equally as valuable.
Well, it was the final salary situation.
Of course,
it was kind of all looked after, that it was taken care of. They didn't have to think about the planning. The properties again. Stories of people buying houses for 35 grand. Got clients that bought a house for 35,000 and now it's worth 2.5 million. Because just time was their friend and the property market has risen so much more. But then you've got that middle age.
Yeah.
Who
relate to that?
Yeah. So the middle age is you're in that hybrid where some of it was sorted, but some of it wasn't, and some opted out, and then it's kind of we kind of did some planning, but we're not.
Fully in,
and now actually,
and also personal circumstances.
Of course, massively
can get in the way. I think about someone gets divorced.
100%, yeah.
Somebody comes into some money unexpectedly. I mean, there's a lot of life events out there.
Well, children are, I can vouch that. Children are a game changer for a whole host of reasons, and be that the younger ones and the middle-aged ones. Perhaps your focus might not necessarily been on financial planning, but might have been on the children or whatever. So sometimes the middle-aged folk are playing catch up, so they are actually very, very, again, there's a shift because they've got eyes on retirement. Very, very, we need to do something, but it's more reactive rather than proactive, because they know they now need to do something and they hadn't done something before that perhaps they should have done, saved X, Y and Z into a pension or done much into a stocks and shares ISA.
Does that mean they make riskier moves, or?
I think some do, but you kind of have to rein that back,
right.
And take a bit more of a balanced approach, because frankly, again, this is their life savings, but they haven't got as longer a period of time to save, and so you need that pot to be secure. And again, it's just about risk, and about the attitude.
But the younger generation are really
proactive,
really?
Yeah. So
and you've kind of got a client for life, really. I guess.
Exactly, yeah. And that's I obviously love working with anybody that is looking to better their financial situation and want to make a change. And I find that a lot of business owners, but a lot of younger guys and girls know that they should be doing something, but often they don't know what, and obviously that's when I come into play. Well, yeah, even guys that have just come out of university, and you can stick away 200 or 300 quid a month, assuming that you've got that spare, and that at the back end will make a massive difference. You're talking
starting in your 20s starting in your 40s. That is going to make hundreds of thousands. I haven't got the facts here. I should have brought them in, but I know you save 200,000 in your early 200 pounds, in your early 20s, and just continue to do that right the way up until the retirement age, and you've got a pot of hundreds and hundreds of thousands of pounds because of growth on growth on growth, and the numbers are staggering. I'll show you them so you can see. My dad, I think, used to say, you can bank on it doubling every 7 or 8 years.
Yeah, that's
and
right.
therefore, over a 40-year sort of working life, you've probably got 5 doublings.
So you have £10,000, and then that becomes £20,000, becomes £40,000, becomes £80,000,
becomes 160, and all of a sudden, it works.
So what I do find actually is when clients are nearing retirement, they recognise that actually, the more you've got in your pot, that bit of growth will have a big difference at the back end. So they're a bit like, oh, maybe I don't want to quite retire, or I don't want to touch that money, because they can recognise the growth of, on 100 or 500 or £1 million, because it makes a real difference. 10% on £1 million is £100,000.
Of course, it's
so
a big difference.
That's towards pensions,
it can be pensions or investments, so
in
growth
terms
on
of what's
an
in
asset.
your pot. I think you used the word pot to mean the whole hybrid
lot
of cash plus investments plus property plus whatever.
Yeah, exactly. Yeah, exactly. So it's very, very fluid, and it very much depends on the individual circumstances.
And I think that's the point Tim was making, is that he gets to know his clients. What's right for me is going to be completely different to what's right for Mark and yourselves. Because we've got probably, sort of 3 decades spanned here between us.
Yeah, and things change. Like
course,
I was saying, children come on the horizon, so then priorities change, or someone buys a house, and then,
When you think that period when you've got your kids, you become almost inward looking, and you kind of leave these things for later, which is a mistake.
Exactly. And actually part of the job is just a review with clients. Having to sit down with clients, and again, traditionally advisors have had a bad rep where they just do something and then they don't touch base after that.
Well, we had the mis-selling scandal of the endowments, didn't we?
Yeah.
Where there was never going to be sufficient to pay your mortgage when it fell due.
When was that?
That was 80s, 90s, was a lot of mis-selling. Then they had a moratorium, didn't they, about you could no longer go back and claim off your provider. Around about 3 or 4 years ago, maybe?
Yeah, they gave an offer, and you had to take it, and then the shortfalls were coming in, and so people were struggling or didn't get what they were supposed to get.
Are those policies now banned? Are endowments linked with mortgages banned now?
I think so, yeah. They mortgages now are a lot stricter as well, so you've got to show, if you're going in interest only, you've got to have a game plan in order to pay that off, or other assets that you can sell down and pay that off.
Yeah, I get that question asked by Santander every year.
With the good old interest.
They actually ask you?
Yeah, they say, how are you going, in 8 years' time, how are you going to play this?
And what do you have to show?
Well, you just I nearly said lie on the form, but that wouldn't be broadcastable. But no, I say from savings or sale of alternative assets or realisation of a pension pot or whatever, and they kind of.
But that's it. They don't really delve in.
I haven't yet had to show a statement with the amount of money in,
or a set of accounts or anything like that.
No.
That could become the point, or they could actually
I
ask
think
for that
they need to be a little bit warmer on
that,
that, really.
Yeah.
Because the interest-only mortgage, for me, is quite dangerous. It's comparable to an endowment.
Well, this was part
especially
of the problem.
now.
Yeah, they tightened up on it after 2007, 2008, because people were just doing interest only, and just rolling it up, and then doing another one, and then they didn't have those kind of questions in place of how are you going to pay this off?
You repayment yourself.
Yeah, mine's repayment. Yeah.
That's generally the way it is.
That's how they
nowadays.
encourage it, but they still do offer interest-only products.
Yeah. Again, typically buy-to-lets, you can do
cheap.
interest only.
Most
you
of them
know
are.
that, and I'm sure you come across that with your clients when you're
Loads.
offsetting.
Did one last week, yeah.
Yeah.
Just interest only, £1,400 interest, 2,200 of rents.
It's easier to calculate.
Leave it alone.
Yeah, exactly. You know, I guess you're buying that asset. Hopefully, it goes up, and you know, from a rental perspective, what you're getting in rent, you can offset a portion of your interest potentially. It's not as much as what it used to be, but it's quite interesting. I don't know how many clients of yours. Again, we're going around the houses, but how many clients of yours have asked about the capital gains tax changes and whether or not that?
As of this morning,
None.
0.
So okay, yeah.
It's highly relevant, because
Do you review that with your clients as well?
We will
Would you
do.
ask that question?
Yeah,
about interest
yeah,
when
I
you
think-
mortgages?
Yeah, because especially now with the change in the rates, it's massive, and actually more are saying come to the remortgage. Well, can I do interest only? And I think banks are open to it, but you've kind of got to prove that you've got something in place in which you'll be able to pay it down.
Yeah, well, they kind of keep swinging, don't they? The banks they swing between affordability and debt to equity levels, and and right now interest rates are moving up, but of course they're not anywhere near historic highs. I mean, a base rate of 3 or 4% compared to one back in the early 90s of 15%. I don't think we're there yet.
And this is why sitting down with clients and helping them with their mortgages or just general planning, you've kind of got to realign their thought process, because very many of my younger ones are, panicking because they're thinking, oh my God, the interest rates are so high.
I was going to say, do you start getting lots of calls when the interest goes up?
Yeah, but to a certain extent, and we are being proactive in saying, look, you can fix up to 6 months before your mortgage ends, and you can lock in a cheaper rate and that sort of thing. But the rates are changing so much that we are on top of it. But you've just got to try and show that actually historically rates have been higher. We've just had an incredibly
it's
low period.
12 years of virtually zero interest rates.
Is that how long it was? 12
Getting
years?
on, it was 2008.
Yeah, so
When
I
the
started
bankers
working
last
to
confessed.
yeah, so 2007 was when I basically came into the finance world, away from working for my dad and stuff like that. And 2007, basically, the rates were about 8%. Seem to remember,
Right, okay.
and that was the norm.
What was the idea of moving from your dad's? Was it just to get some more experience?
Yeah, well, he actually sold his practice.
Oh, right, fine.
And so I also wanted to, go work elsewhere. And actually, we talked about where I worked. I did a year in the Caribbean, which was interesting.
That's right, yeah.
Yeah, did a year.
So what age were you working for your dad? Literally from school?
So yeah, did a bit for Dad then.
What was the bit B?
So
nosy now.
it was studying admin. I mean, right the way to doing letters and things like that.
Oh, okay. So
that was
support,
it. Yeah,
supporting him.
very much back office support.
Okay.
So Dad sold up his practice,
Yeah.
and then I went off to university. So this, when I was saying work for my dad, I did it in holidays and things like that.
but
Yeah.
you
Get the experience.
of course.
picked up, yeah.
And so I actually went to Loughborough, and I did banking, finance and management at Loughborough, thinking, right, I'll do that.
So
And
in the zone.
yeah. And then whilst it was fun, I enjoyed it, I kind of thought, well, if I'm an idea, I'm probably financial advice or accounting. I didn't necessarily want to be a trader and look at screens all day. I wanted interaction. And for both of those professions, you have to do your exams
Yeah, of course.
externally away from universities, right? I think that's
That's
correct.
right, yeah. Same for us, yeah.
Yeah, we have, we have the
professionals.
Institute of Chartered Accountants of England and Wales.
Yeah,
Did the university
party.
course add much, looking back at it now?
a little bit. Like, I had a sound knowledge of economics anyway.
Yeah.
And then did that at school, and then did a bit at university, and then it gets, more complex than perhaps you necessarily need for financial advice.
Did you have any sort of touch points in the 3 years that you found sort of more interesting than others?
So I did enjoy the economics element,
Right.
but then economics gets so theoretical, and so you could argue anything as long as you've got a good argument. And so I actually only did a year at Loughborough, and then I dropped out and went straight into work for financial advice.
Oh,
I gave it a year because they offered me a job.
Right.
So I deferred my university year, and I was like, well, I'll go and see what it's like. I can always go back to uni if it doesn't work out. And actually, I learnt more on the job than I did, in the classroom or whatever.
Well,
and
it's sort of true of apprenticeships generally, isn't it? I mean, our guys out there, they're on apprenticeship schemes.
Yeah. And
I did it as well.
Yeah.
And I'm a big advocate for it because, I'm learning about the funds. I'm at client meetings. Obviously, I'm not doing them, but I'm just a witness to them, and you're doing your fact finding and all the process. And
it all goes in. You think you haven't learnt that much.
It kind of just naturally absorbs. It's almost like osmosis. The terminology, and also confidence around the advice you're giving.
Yeah, and so I did that for a year, and then it didn't work out because Antigua and the Caribbean.
What on earth did you see in Antigua and the Caribbean?
Yeah, well, I went from Antigua to Lancaster, which was a big
bit of a jump.
And then my dad had then set up another practice, so actually I just went back to work for Dad and just did my exams whilst working for Dad. Again, doing a lot of administration.
Of course.
Learning on the job about all the various investment types, learning about the underlying investments, learning about stocks and shares.
How long did those exams that time take, or are they never
about
finished?
They're technically never finished, but in order for me to sit down in front of people, which was then once I got qualified and moved down to London, I think that took around about 3 years, 2 to 3 years. You can do the exams really bunched up, and you could do them in a matter of months, but I was doing it whilst working on the job as well. Whilst also,
it's a bit like our 3 years training contract.
Would you have to have a certain number of days of experience? Or we have to have 450 days of experience.
Of relevant experience.
Yeah,
top
it
of
might
your
have
exams.
changed. It might have changed now,
Yeah.
but at the time it wasn't. It was just a matter of get your exams done and then you can go out and
Tough
serve.
exams.
How difficult.
They were relatively tough. They're more tough now. So
really?
what you could do initially, you could just do your exams. I can't remember the term. Certificate, effectively. So you got certificate diploma chartered, and the certificate was difficult.
Yeah.
But then the diploma is more like a university degree. So that's where I'm at now. That's what I'm qualified as.
That was more being financially aware.
Yeah.
And I think, as Tim's touching on, having that backdrop, and you said yourself, it ekes into your psyche of it, without maybe knowing it.
Yeah.
But you often listen to people on the TV. I think there was some people on over the weekend. A guy who'd started up a chain of coffee shops, and he said you can't get away from the basics, which is know how much income you have and know what your costs are. And having that very, very straightforward approach had served him well, and we're often reiterating that point.
I think the experience that I've gone through is kind of, instead of going straight into a big firm and then not really knowing the nuts and bolts, I was fortunate enough to, experience my dad building up another business and seeing all of those nuts and bolts, and as my career has progressed, then being a business owner myself 8 years ago, again setting up your own business, like it's all relatable. I know the worries and the benefits and the upsides and the downsides of
where are you now? Where is Lambert Wealth at now?
Established, happy in that respect. I've got a great bunch of clients, and it's self-fulfilling in there, but I'm always looking to build and grow. Previously it was just me, and then I brought Julie on, and now I'm getting a mortgage guy on. I had another chap, and we're going to bring on another trainee advisor next year. So it's now got to the stage where I'm growing the business. I just wanted to make it sure-footed and sound, and actually there are many advisors out there that are solely on their own, if that makes sense, just because then when you start employing people, the whole dynamic changes.
Yeah, being a wage maker is difficult.
Yeah, exactly.
So we would look at a P&L, we would advise a client, and we would say, this is what you need to do, and this is where you might be making profit, or this is where you need to cut down. We'd also advise on tax and things like that. But where it comes to like Tim, so where we get Tim involved is where a client is on a certain growth path. Now, maybe we should get them in sooner, but we definitely work on a growth path. So where that client is established themselves, making money, they then need to start planning for the future. Be it an exit route, be it selling, or, taking more people on, like we talked about the insurance. So that's when we kind of get Tim involved, and definitely for the pensions.
Yeah.
Well,
Pensions
Tim,
is a
it
new
was
world
Tim,
to me.
wasn't it, that really got us thinking in terms of the life stages of a business. I mean,
Well, you did it on a
we-
nice document that we're going to get
yeah,
out
you
to
should
everyone.
be getting royalties on that about now, because that whole startup, growth, plateau, know your products and clients, and then think about leaving.
Yeah.
That really, at that point,
Yeah.
it lends into wealth management, because if you're coming out with a successful business, chances are, if it's of any size, you'll be looking at 2 commas, so 7 figures.
Yeah, so I mean,
Some big decisions.
that is the difference there, the wealth management side. We don't really... We can advise on a business side and where we think things can improve, but wealth management is definitely, it's over to Tim.
If a client of ours was to generate 100,000 surplus in a particular year, we'd be typically advising them to invest to grow the business, maybe in qualifying plant machinery, assets, more staff, maybe more marketing to increase the sales. It was only really since we've been dealing with you that we think, how about yourself?
Yeah.
How about pay yourself a little bit more, put it into something for the future, because nothing lasts forever.
I think, again, in terms of clients have asked me, can you help me with this tax return or something like that? Or, what do we do for our business? How much tax are we going to pay? And I said, well, you guys are very good at, laying out what the plan is, what your cash flow is, how much business, how much money you've got in order to operate that business and invest back into that business, and how much tax you've got to pay. Whereas I'm then, okay, well, you've got that much tax to pay, or you're going to put that much back into your business. What's left over? How do we? What do we then do with that excess, perhaps?
But that will benefit the
And where to
company as
go.
well.
Yeah.
Often...
You'll save corporation tax,
Yeah,
for
you've given
example.
some solutions to clients of ours that's massively saved them corporation tax, which, helps everyone.
Yeah.
Yeah, we
It's the
talk
bottom
about
line.
tax leakage and tax efficiency. No one has an obligation to pay the maximum tax, but everyone has a moral duty to pay the legal amount of tax. And
Yeah.
therefore, with investment in pensions, investment in assets, rolling into other businesses, it's all legitimate ways of and choices, right? What
Yeah.
you do with your surpluses, and that's really Tim's strength. Well, we're not licensed. Yeah, we're not licensed to give investment advice, which is the basic. Which side of the line are you on? We can advise about cash flow and growing a business and how to make your tax leakage minimum, but we can't say, oh, and if you stick it in cryptocurrency, bosh, expect this return. Tim has quite a lot of models where he can take surpluses, he can look at different, scenarios. If this amount of growth, then that, if you do this, then maybe you think about some higher risk investments if you're maybe playing catch up, or it depends on the person's attitude, I'm guessing.
Yeah, and their personal circumstances as well, and what they're looking to achieve. It goes back to that. You're setting up a business. What for? Are you looking for an exit, or what's your situation at home? Do you need 50,000 or 150,000 to live off? Okay, well, what's the excess? How best do we help you achieve your goals with what you have got at the moment, and then continuously, because it's again constantly changing, isn't it? Each year.
Do you always ask somebody, one of your clients, about retirement? Or do you
Generally, it's not necessarily
tailor the
retirement.
conversation?
Yeah, it's perhaps they'll come out with it straight away and say, you know, I want to finish or I want to sell up at this age. And if not, then I would ask the question, so when would you like to have the option to slow down? You know, it's not necessarily a full-on retirement, because that's very difficult to be done, finished with work, you know, and especially now with people who've got businesses and, you know, their own things going on. So now it's, when would you like the option to slow down or be self-sufficient effectively?
Well, that's more about in terms of insolvency and in terms of liquidations and administrations, where, you know, with the best will in the world, directors and managers of businesses have tried everything, and we've offered solutions, and they haven't really been able to survive. The business model just didn't work for whatever reason. Could be external events, could be, you know, catastrophic events. That's what we mean about the end of life. Typically, is when you actually legally close down a business, maybe liquidate it or place it into the hands of an insolvency practitioner.
Also, company directors selling up as well. We've gone through that a couple of times. Well, a few times now. Yeah.
But, you know, with terms of Tim and the wealth management side, that's more about a successful business, maybe plateauing, maybe they feel they've taken it as far as they want to, and then what are the choices in a solvent business? That's what wealth management for us. Exiting, we use the word exit to mean sell it, you know, pass it on to your family, take external investment, you know, offer it on the market.
Yeah.
Well, it's almost as well some of the sports people, you know, it's those which are stack-ended front end, you know, and you're talking hundreds of thousands, not millions, in the first 5 or 6 years of working potential, but versus the traditional profession, the lawyer, the accountant, the chartered surveyor, which is, they're just gradually getting wealthier as they progress with their experience. So it's a very different it's a different advice, I'd imagine.
Yeah, very different approach.
Like that?
Yeah, well, you know, I've dealt with footballers, prime example, social media individuals as well, where it could potentially, certainly with footballers and social media, a finite career. You know, I usually, the term finite career, I work with models as well. So they 5, 10, 15 years, hopefully, of earning real, you know, big money,
and the lifestyle gets used to that,
and so that's the other thing. It's like making sure that they've got enough money in order to maintain that lifestyle, and part of that is curtailing the current lifestyle so that then you're putting a bit away so that then you can draw sufficient income at the back end.
So it's almost leveling it up.
Yeah, whereas a quantity surveyor or somebody with should we say a more steady business that could potentially work until the traditional retirement is then going to have a different element of advice for pensions. Traditionally, you know, it does suit them because they can draw that from 55 or 57.
Yeah, fixing the roof whilst the sun's shining, I guess.
Yeah, the younger higher earners, you know, it's about saving tax to a certain extent whilst also generating growth and then being able to generate sufficient income at the back end. And there are things that we can do that are very, very helpful and can project that for clients so that they can see, but also just so that then they're comfortable in the knowledge that their affairs are being taken care of.
So at the moment,
in the right way.
If someone's thinking about buying a Bentley Turbo, you might say you can get a more tax efficient use of that cash because
elsewhere.
You can invest up to, is it 40,000 or 50,000?
You can do 40,000 into a pension, and that's completely counted as a business expense. You know, so that's 40,000. Assuming that they're buying a Bentley, you know, they're going to buy it from their personal income. You have 40,000 come straight into a pension from business. That's 40,000 invested. You take that 40,000 and pay yourself an income. You're only going to see 20,000 of that.
Yeah.
So you're immediately giving yourself a 50% tax bill, and then you've got to save a hell of a lot in order and pay a hell of a lot of tax in order to get that 220 grand Bentley.
So 40,000 is the annual limit?
40,000 is the annual limit for a pension, but you can also carry back previous years as well, to a certain extent. So
How many years back can you go?
3 previous years as well. So
Right,
you can
okay.
actually do 40,000 for this year, but then also 120,000 for previous years. So it's up to
just
160
for
grand.
my benefit.
Yeah.
So 160,000 potentially if you'd had a very, very, very good year, and you would pay no tax on those.
Comes off the top line. You know, it's got to qualify, so you've got to have sufficient earnings, and it's got to be a reasonable business expense. You know, so there are qualifying things, but the long and short of it is 160,000 up to could go straight out of the business, no tax, no corporation
and thereafter
tax,
40 a year
and then
until
40
it dries up.
40 a year, which then adds up to a hell of a lot as well.
Well, there's more benefit because you can have this taxable
Tax
allowance.
deduction
Yeah,
against your
tax-
corporation tax, but ultimately, it's just a slightly different legalese, right? It's
Yeah.
a slightly different structure, but
It's
ultimately, sole trader, partnership, limited company, everyone you can encourage to
Put in.
Provide.
The top line is be a sole trader, an individual, or a limited company. The gross amount will effectively go into the pension. So a sole trader will get full tax relief eventually against the personal tax. So again, there's no tax to be paid once it goes into pension. So you can save a hell of a lot.
What's the limit on that one as well?
40,000
So-
again. So it's a similar principle, and you can use the carryback as well. If you were a sole trader and earning a couple of 100,000 a year, you can offset.
Yeah.
Yeah, which goes back to what we were saying about if you're a footballer or a model or an influencer and you go 2 or 3 big years,
Yeah.
you can max that benefit.
You
and
can
then
max
adjust
that.
it going forward.
Yeah, and then there's, and we probably haven't got time, VCTs and EISs, which are 30% tax relief.
That's right,
Venture capital trust, enterprise investment schemes. They are higher risk. There's a lot of caveats and things like that with those, but you can get 30% tax relief on the
Well,
investment.
that sounds like another episode for another day.
I think that is definitely another episode
I like
for
the
another
sound.
They're
day.
popular there, then.
They're
yeah,
great.
we've had a few people asking about venture capital trusts. Are
Yeah.
they just more flexible? Just give you access to higher, or
Shorter
different assets?
shorter time frame. So they have to be held for 3 years and 5 years, as opposed to up until retirement.
Right.
And the money, once it's into these schemes, realistically should remain there. But it does, from a planning perspective, provide a lot more flexibility for the younger clients that are willing to take a bit more risk and can take a bit more risk because they're earning a hell of a lot.
Plus, if something were to not work out, there's a little bit more time to catch up on other investments, I guess.
Exactly. But should we say that's for another day, because
I
they
think
are
definitely another
cracking.
day. Well, thank you very much.
Thank you very
for
much.
coming.
All right.
Thanks very much.
I hope
Thanks for having
everyone's
me.
learned quite a lot. You've been watching. Well, thanks to everybody for coming today, watching. Thank you, Tim Lambert Wealth Management. We at Cubed use them. I'm sure all their clients are grateful, and hopefully some of our clients have learnt 1 or 2 tips for today. And of course, check out the website and get in contact if you need Tim's help.
Thank you. Cheers.
Thanks so much.